Welcome to The Tax Factor, the UK's top tax podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with Earle Theochari and Rehana Earle.
I'm Earle Theochari.
And I'm Rehana Earle.
Our thanks to Roger and Neil for last week's podcast, but following one stellar double act, this week you get another.
Yeah, I have a sense of deja vu, as last time we were talking about inheritance tax and farmers, the national insurance increase that is set to come in April, being just one of the issues troubling many retailers, and both are still rumbling on, Ellie, as we approach the budget at the end of the month. So, what's caught your eye this week on the tax front?
Well, with Pancake Day just behind us, farmers were at Westminster again protesting about, the inheritance tax changes in general, but there is another consultation that the government have just launched, and it's specifically to do with how agricultural property relief and business property relief, so from here I'll just say APR and BPR, will apply to property that's settled into trust. So there are two main incentives to settle property into multiple trusts, and this reduces the impact of the £1 million allowance for trustees. As an example, if you had qualifying assets valued at £5 million, you could settle this into 5 trusts in equal £1 million shares before the 6th of April 2026, and that would have no entry charge provided the settler doesn't die within the usual 7 years, which is the IHT rule, and there's no 10-year anniversary or exit charge on the trust, as that higher rate of 100% would apply to each trust up to the £1 million allowance. Obviously, that does assume that the property in each trust stays at or below the market value of £1 million. And of course, the advantage to doing that is that within each trust, you would then get that £1 million allowance against that 10-year anniversary charge and exit charge. There's also some valuation advantages. So when you're looking at certain assets, particularly shares, they might be discounted if they are fragmented in different shares. If that no longer constitutes a control or majority holding, that lower valuation feeds into the calculation for those IHT charges, and then that total inheritance tax on that 10-year anniversary may be quite a lot less if it were to be held in a single settlement. Now, HMRC and the government have cottoned onto this. They're now suggesting that if you do have qualifying agricultural or business property that has been transferred into multiple settlements on or after the 30th of October 2024, being the date that these rules were first announced, there will be one single £1 million allowance for that 100% relief. So that will be in chronological order with priority given to that first settlement. So you'll have your 1 million and then it will sort of go through each of those different settled trusts up to the value of only 1 million. So you won't get the benefit of having a £1 million allowance per each trust. So that allocation of that single £1 million allowance will be applicable to each trust and apply for the lifetime of the trust. That's a huge blow if we look back at our example where potentially you could have £5 million across different trusts. Now you'll only be able to get that £1 million allowance. For farmers, it's not great. And I guess the backdrop of this is there was also a recent survey undertaken which suggested that actually more than a third of UK farms could be out of business in the next 5 years. It's a very worrying outlook, particularly with 60% of farmers saying that their businesses wouldn't be financially sustainable in the future if the Chancellor does go ahead with this IHT overhaul. A huge part of that is there is a real possibility of farms having to get into debt, and that's through entering into various loan facilities and finding any kind of way that they can to cover these IHT costs in the future.
God, thanks, Ellie. That is actually, quite worrying, I think, statistic for UK farms and farmers in terms of certainly that statistic around sustainable sort of business in the future. And I think that and the combination of kind of what's just happening from a global trade backdrop, the uncertainty there that we're witnessing at the moment, I think, really we should be trying to do everything we can to encourage certainly that supply chain and, supporting our farmers. And so it will be really interesting to see if any of this lobbying does actually have any impact, whether there are going to be any changes, particularly to obviously the APR and the BPR that farmers are lobbying on, and whether or not the Chancellor will take any of that feedback on board. I guess, which we'll come on to in a minute in terms of some of the other stuff that's happening with the spring statement, but there's still obviously this backdrop that there's a hole to fill, spending and tax rises, etc. happening. The reality is probably that there won't be, but we will have to see what happens with that. So turning to ISAs, Ellie. So Roger and Neil had a good discussion about this last week on their podcast, talking about the investments and where people should be investing and the UK ISA that seems to have kind of slightly fallen off the radar. But just a reminder reminder for our listeners, and particularly I think in relation to a recent survey that the Building Societies Association carried out recently, which showed an overwhelming majority of savers who have cash ISAs are against the government scrapping or reducing them in favour of pushing stocks and shares ISAs. And so we know certainly from the discussion last week and everything that's been reported that there are rumours that the annual tax-free allowance for cash ISAs may be cut to £4,000 per year from the current 20,000. And 90% of those surveyed in the Building Societies Association survey said it was more important to them that they have the guarantee that they'll get back at least what they put in, where they just don't want that financial risk of a stocks and shares ISA. And given kind of what we've seen over the last couple of weeks, I suspect there will be more and more savers who feel the same way about this, with stock market fluctuations, going up and down, and again, all the sort of geopolitical sort of tensions. HMRC's own figures showed that almost half of all cash ISAs are actually held by those with incomes of less than £20,000 a year, meaning actually the impact of this is that there's a real risk to low income groups of losing the vital means of saving their money sort of tax-free. Again, I think we're going to have to see what happens, but I hope that some of this is going to be taken into account when this is all sort of being considered, because it could have a real impact on low income households as well.
Absolutely. And as you said, with the current economic climate, we've got, inflation is, sometimes it goes down, sometimes it goes up, but it's nowhere near where the Bank of England want it to be. People are having a huge difficulty getting mortgages. There's a cost of living crisis. The energy price cap has just gone up again. Exactly as you said, people want the certainty of at least I'm going to get back what I put in, rather than I might actually, there is a real risk whenever you invest in the stock market, you might lose it all. And you have to be prepared to do that. And at this time, especially if you have an income of less than £20,000 a year, why would you choose to do that? So the Chancellor really needs to think about what is best for the average person. I know there will be businesses out there that are lobbying on behalf of themselves and, members, because of course they want people to invest in the stock market. But what does the average person want? What does the electorate want? It'll be very interesting to see what happens on the 26th. But moving on to another survey. So this was carried out by the British Chambers of Commerce. They found that 6 in 10 businesses were already reviewing recruitment and expected prices to rise within their businesses. This doesn't really come as much as a surprise. As everybody will know, we've discussed it and it's been discussed and critiqued at large by individuals and businesses. There's less than 6 weeks until the employer national insurance contribution rises come in, and businesses are being squeezed over and over again. The minimum wage increase is also coming in at the same time. The Chancellor does have this hole that they speak about that they need to fill, and these rises are actually expected to bring in 25 billion a year, but it is SMEs that are bearing the brunt. And a colleague of ours, Robert Salter, had actually done an analysis, and it looked at the impact of this rise on somebody earning £30,000 versus somebody earning £150,000. And it's actually for the employer, it's those businesses where you have the lower end incomes that actually hits them the hardest. And it is no surprise that there will be big discussions about, do we promote, do we hire, how do we give pay rises, how do we look after our staff, how can we keep our prices competitive? So that is yet another thing that businesses are having to deal with at the moment.
Yeah, I mean, absolutely. And I think we've had the same running theme, as you said, kind of over the last few weeks, because there's still that fear. It hasn't hit yet. These changes are coming in the 6th of April. I think people are hoping that there's going to be some sort of change, but in reality, are we going to see that happen? So it definitely feels like a bit of a ticking time bomb. And it's just really not clear how the government are going to alleviate some of this without making any U-turns. But last week, Keir Starmer said that the government was looking at whether, they needed more tax rises or whether spending cuts would be put in place to meet Labour's self-imposed fiscal rules. And actually, it's emerged that the Chancellor has earmarked several billions of pounds of welfare cut and other government department spending cuts as well. And actually, on Wednesday, the Treasury is going to inform the OBR of its, in quotes, major measures. And that essentially means what changes to tax and spending there'll be in order to meet the government's borrowing rules. Personally, I'm not really sure what else Rachel Reeves can do with tax increases. It feels like that has just been kind of pushed to the limit it, certainly for employers and the knock-on effect on employees that are set to come in April. So I think we're just going to have to watch this space for further comment following next week's announcements. But now on to a couple of bits of other news from HMRC. Firstly, they're starting to send letters to taxpayers who'll be affected by the introduction of making tax digital for income tax, advising that they will need to report quarterly. So the first letters are going to hit the post in April, with landlords, sole traders and self-employed with income over 50,000 the first to receive them. The rules don't kick in until 6th of April 2026, and this will be the first time individuals have been told personally by HMRC that they'll have to comply with the new making tax digital reporting requirements. So now that the initial testing phase has actually reached completion, HMRC confirmed that from April 2025 there will be 2 sign-up options to enrol in MTD, I'm going to call it, because otherwise it's a bit of a tongue twister. So there are a couple of options. There's one that you can kind of sign up to from April 2025 for accountancy firms and clients to get themselves familiar with the changes, so they'll be early adopters. And there's another option to sign up during 26-27, and HMRC is kind of, in this option, leaving it to accountants to decide which option to use, basically. I think the most important thing is that people know that this is coming, that they understand what changes they'll have to deal with, and make sure that they're either kind of signing up as of April or they're signing up as of April next year and they know exactly what they're doing.
And secondly, there are 3,000 PAYE taxpayers who have been signed up to a voice recognition system. So this will be a 6-week trial to help HMRC detect potential fraud, deepfake calls, and the use of artificial intelligence for not very nice means. So this initial trial for the voice ID technology began last week, and it will run for 6 weeks. The benefit of the system really is that at the moment, it is kind of easier than the current security system because passwords and security questions won't have to be remembered. And therefore, you're getting a secure, quick, and easy method of actually getting into the data. As we all know, AI, deepfake, spoofing technology, they are all advancing at a rate that's actually very difficult to keep up with. And they, HMRC do recognise that this can cause problems going forward. So they're implementing what is known as Nuance Gatekeeper 2 technology, and this will detect deepfake voice calls. The system, developed by Nuance, is owned by Microsoft and claims to have a 99% authentication success rate, and it takes 2 seconds to authenticate a legitimate call and 15 seconds to determine if the call is fraudulent. What will happen is the taxpayer's voice will be stored on an internal system. The Nuance system will then identify and verify when receiving a call from that taxpayer whether that voice is correct, and therefore it can act as a password. The rollout will then be part of a wider upgrade to HMRC's telephony system, which actually is currently out for tender. And HMRC are just looking at generally how to use AI more effectively in its business. I actually had a deepfake call the other day, not from HMRC, but from somebody pretending to be from my local council. To me, it felt very obvious that it wasn't real because it had the absolute classic signs of urgency. I need something done now. I need payment, all that kind of thing. But I just thought to myself, what is this? It's actually a bit scary. So it's good that this is being rolled out.
Yeah, absolutely. And you can imagine vulnerable taxpayers really being caught out by some of this. So
absolutely.
I think it's really important that the systems are put in place to support that. AI is taking over, it seems, but hopefully for a positive. So yeah, it looks like AI might be taking over after all, Earle, but hopefully in this case for good reasons. But to finish up, as we approach the end of the tax year, don't forget to take advantage of your tax-free allowances before 6th of April. If you do have any spare cash, make sure you're making use of your exemptions and reliefs. That includes inheritance tax gifting, crystallising gains to reduce capital gains tax liabilities, and topping up any pension contributions. And of course, ISAs that we mentioned earlier do make use of the existing £20,000 adult ISA limits or £9,000 for child allowances before it's too late.
The Tax Factor from Blick Rothenberg.
I think that's all we have time for this week. If you enjoyed this episode, why not check out our sister podcast, Brave Business, which last week was number 1 and number 2 in the Investment and Business podcast charts. In the business charts, this is sandwiched between Stephen Bartlett and Martin Lewis. Hosted by journalist and broadcaster Declan Curry, the latest episode dives into the founder's mindset, what it takes to lead, grow, and adapt as a business owner. You can listen on our website or wherever you get your Tax Factor podcast.
We release a new episode of The Tax Factor every Friday on the Blick Rothenberg website and all the usual podcast platforms, so you can listen wherever is most convenient. We record and release them in less than 24 hours, so you always get the very latest news and updates. If you enjoyed the podcast, please subscribe and give us a rating or review.
Next week, I'm back. 2 weeks of me in a row. I'll be joined by Tom Adams. I wonder if he'll have a quiz for me. You might remember his maybe famous, maybe infamous Poppadom quiz. If not, do check out episode 38. But until next time, it's goodbye from me and happy International Women's Day for Saturday.
Have a great weekend, everybody, and goodbye from me too.
That's the Tax Factor. If you enjoyed the Tax Factor, please like, share and subscribe. Join us again next time on the UK's top tax podcast, The Tax Factor. The Tax Factor is a Blick Rothenberg production. Copyright 2025.